Hello and welcome back to... I've now forgotten what it's called. Well done me. Okay. Hello and welcome back to the Bardic Gateway. In this interview this week, we are talking with Megan, who is an amazing Troubadour alum actress and one of our troupe, and who also, as her muggle job, works at an investment bank. Exciting.
For all my sins.
For all your sins. Today we're hoping to cover everything from savings and investments for creatives to pensions, ISAs, and all those kind of things which none of us really want to think about. And also a little financial disclaimer, which is legally necessary. This is general information. Nothing should be construed in this video as financial advice. So, that out of the way, Megan. Basic question, first of all. Why should actors and creatives think about savings and investments?
So there's kind of two distinctions that need to be made here: savings versus investments. I'll tackle savings first. And honestly, it's because the industry by nature is very, very unreliable. So while, you know, if you're not making an active effort to save, it just means you have less of a cushion to fall back on should you have to go without work for a couple of months. If, for example, you don't land that particular gig or you decide to take a break and do something else, having good, solid savings as sort of a foundation underneath you will give you a lot more freedom. For example, if you're in a job and your dream role comes up and you really, really want to go for it, but it means that you're going to have to quit what you're currently doing, without a firm kind of like nest egg underneath you, you're not going to be allowed those freedoms. So saving in general is obviously important for everyone because, you know, life happens. You might have to pay this bill, that bill, etc., mortgages, all on things on the horizon to worry about. But particularly for creatives who can't really say that we have financial stability or kind of work stability, just look at the last 2 years of COVID. You know, you never know kind of when you're going to have a dry spell of booking particular jobs, etc., or when theatre itself is kind of have a low season, for example. So it's good and important just to have that cash for emergencies, just because you don't want to find yourself up the creek without a paddle. So having some sort of kind of budget for yourself every month and tucking a little bit away inside just in case can sound a little bit pessimistic, but you know, it's also realistic. It's one of those things that you kind of need to have just in case, as it were. Now, investing, particularly as a way of saving, I guess is the best way to think of it. Investing's have got a lot of, I guess the best way to say it is kind of stereotypes surrounding it. It can seem really inaccessible. I think when someone says investment bank, the first thing I think of is basically Wolf of Wall Street and how cute Leo DiCaprio is. And kind of the scenes where the stockbrokers are, exactly, like throwing paper and shouting at each other. The reason why, particularly at the moment in this current economic climate, why investing is a choice that, you know, should be considered is all to do with, one, inflation that we're currently having, and also interest rates being spectacularly awful. So, for example, with like my personal... sorry.
Just quickly, just kind of why, when you say interest rates are awful, just for the layperson who doesn't really know about this, why does that matter? Why does interest...
No, thank you. Good question. So essentially, an interest rate is if you have your savings account. For example, mine at the moment is on 0.01%. So interest, in the very kind of basic terms, is for keeping money with your bank. It's almost kind of like a little reward scheme, and the percentage is how much money you will gain. So if you put £100 in and the interest rate is 3% a year, you can expect that by the end of the 12 months, you're going to have 3% of 100 added to your account as like a little thank you from the bank. And normally interest rates are quite competitive. So it's kind of one of the ways that banks incentivize you to use them rather than competitor A, B, C, D, etc., etc. At the moment, because of the coronavirus, no banks really are offering good interest rates. I'm personally on 0.01%.
I think I am too, yeah.
And it just means that your money is sitting there not doing anything. And while over the short term, that's maybe not necessarily a huge problem, over the long term, if the interest rate's lower than the general percentage of inflation that we have each year, it just means that your money actually ends up being worth a lot less. So at the moment, inflation, which is essentially how much the cost of living goes up every year. It's something like 1.3%, I think, having a poke around a couple of weeks ago. So if you're sitting on, thousands of pounds that are on 0.01% for 50 years, and in every single one of those 50 years, the cost of living and inflation goes up by 1.3%, the money that you're putting in is not going to have the exact same value as it would when you originally put it. So you can't just have your money sitting there doing nothing, which is what interest rates are looking like at the moment.
Okay, so probably the way to explain it from what you're saying is that as long as interest rates are lower than in the inflation rate, you are losing money if your money is sitting in your savings bank account at your local high street bank. Is that?
Exactly right. You're losing the value of your money. And, while over 2 years, that doesn't seem like a big deal. If you're saving for 50 years, you're going to want to make sure that all your hard-earned cash is working as hard for you as it could possibly be. So you end up sitting on like a cushy little retirement pot rather than having like a baked beans pension and kind of having to live off very little, or potentially not being able to pass anything on to your family.
Okay. So, I am an actor or a performer or a creator. I've just done a tour, and so I've got a bit of surplus money, or, I've just come off a job. I know about this thing called ISAs or index funds or investing, and I know that I probably should be doing that, but also we always hear we shouldn't be, you could lose money, it's not entirely safe, you hear about all these different figures of, S&P 500 and blah.
Yeah.
Where the fuck do you start? What's the first steps to?
Yeah. I think the first couple of steps are probably going to be working out if investing is right for you. While obviously it's something that over the long term is very beneficial, it means you can't put yourself kind of out over the short term. So the general rule of thumb is that over time, investments tend to have a better return than just interest rates in the bank. But that is over time. If you invest into something like shares, which is, on the stock market where all the movies and the famous scenes come from, they go up and down like literally every 15 seconds. Their price is constantly changing. It's not uncommon for them to suddenly drop one day and then suddenly rise another. But the general trend is that they will, over time, over say 10 years, they will eventually increase. You just need to be able to ride out kind of like all the frantic like lumps and bumps that you get along the way. So if, for example, you have just come off your tour and you're like, I'm going to stick all of it into an ISA, I'm going to invest it into funds and shares, and then 2 years down the line, you kind of need that money for whatever reason, and you picked just equities, just shares, and they're all doing terribly, you're going to be feeling very concerned and not have much money to kind of go buy yourself a nice dividends. So it's figuring out, one, do I have enough money? Can I sacrifice this and lose it for potentially 5 years? The general rule of thumb is that any money you put into investing, you have to be happy not to touch it for about 5 years, because that will generally give it time to go through all of its ups and downs, but also have that upward trend. So it gives enough time in order to actually kind of go through all the ups and downs, but grow eventually. The longer you can leave it, generally, the better. But the minimum really is about 5 years. Yeah. So if it's one of those things where, for example, Granny's left you like a nice little something in the will, or you've made a lot of money and you're like, you know what, I don't know what to do with this at the moment, and you think in the next 5 years, reasonably, I don't need to have that instant access, that is when investing starts to become a good idea, but only when you're ready.
Okay, great. One thing you mentioned in there is the ISA, which I think confuses the heck out of all of us. Do you want to quickly go into that a bit more?
Sure. So with an ISA, it stands for an individual savings account, and it's very heavily regulated by HMRC, but essentially it's kind of a tax efficient wrapper. So for example, let's say I put 10,000 into a stocks and shares ISA. I can take that £10,000 that, Uncle David left me, and I can invest that into some funds, into some shares, into a whole kind of wide array. Any money that I make, any money that gets paid out to me by a share, or if something goes up in value, is going to be protected and shielded from capital gains and income tax. So essentially, if you have the time and you pick a couple of lucky investments and you make a fair bit of money, that is untouchable in terms of tax. You're not going to have to add it. It's not going to push you into like a different tax bracket or anything like that. So that's one of kind of the really big advantages. Whereas if you kind of invest in a non-ISA product and it does really well, potentially you're going to have to pay capital gains tax or income tax, and overall could actually end up biting you in the arse a couple of months or years later down the line.
Okay, so again, I'm just going to keep on picking up on terms just to kind of
do it.
So income tax, I think everyone is aware that income is the general thing with the self-employed, but always kind of putting our expenses against our income to bring it down.
Yeah, absolutely.
Capital gains, please explain.
So I cannot sadly brag to be a tax specialist, but capital gains tax is essentially if you make a fair bit of money in an investment account that's not shielded by the tax efficient wrapper by an ISA, they're likely going to sting you for it because it's not coming underneath your income. You're not just, sadly, alas, HMRC do not allow people to just kind of make loads and loads of money on investments without some kind of repercussion. So capital gains, if your investments make above X amount or Y amount, you're going to be taxed heavily on them, which is why the ISA is fab, because it just kind of shields you from both of those options.
Okay, so it's a bit like if you bought a painting by this unknown weird artist and you bought it for nothing, and then 30 years down the line it turns out it's Pablo Picasso. And
or Banksy or whoever it's going to be.
And suddenly, like, the price you paid and the price which you can now sell it for, there's just this enormous difference. So HMRC taxes that difference. Is that right?
Exactly right.
Okay.
Yeah.
So when you're in an ISA account, you are protected from that tax on that growth.
Yes. So while in an ISA, for example, and unfortunately you cannot hold paintings, but if you invested into this tiny little startup that you found or your friend started, and then years later turns out they're in, I don't know, the FTSE 100, they're one of the biggest 100 companies in the UK or the world, in fact, and you've made £10 billion, it's in your ISA. You're not going to get taxed on that. You can take it out as much as you like. So the ISAs are very beneficial to those who do make those lucky choices.
Yeah. Brilliant. All right. I think another general definition one, which I think you're going to hate me for.
Oh no, what?
What's stock? What's a share?
Right. No, that's a very, very good question. I'll start with shares. So essentially a share is kind of like a slice of the pizza. So let's say, for example, Apple. If you buy a share in Apple, it's almost like you're buying part ownership of Apple, of the company. So if you hold 5 shares, it's kind of like you have 5 divided by kind of how many different millions and billions of shares that Apple hold, but you've got part ownership. And that means essentially you can buy and sell into these shares at different times, depending on how well the company is doing. So for example, if Apple release a new product and they make a bunch more money and you've got 100 shares, the value of your shares will go up. If you then sell at that particular point, let's say you've invested into Apple right at the very, very beginning when they were still kind of like a itty bitty fish in the pond, you ideally want to sell at a higher price than where you bought. So you get things like shareholder privileges, which means you can kind of have your say and vote on things that are happening in the company. Obviously, with smaller companies, the share is a bigger slice of the pie because there's less of them to go around. If you're looking at something like Amazon, you'll get like a teeny tiny crumb, but it will be your crumb, and that crumb is traded live on the stock market. So it goes kind of up and down in value very, very quickly. It's kind of all connected to this fantastic giant Ethernet on the London stock market.
Yeah. Okay. And and a stock.
On the other hand, so shares are kind of, they're referred to largely as equities. Stock is also sort of part of that. The other thing that is kind of widely available is something called a fund. So with equities, with stocks and shares, it takes a lot of research. You can't just go company X and cross your fingers, hope for the best. I mean, you can, It's an unorthodox tactic, and it might work, it might not. There are no guarantees in investing, but it normally means you have to take a bit more time doing some research, and you need to have a little bit of knowledge, a bit of know-how, and know your way around how investing works. Whereas with funds, for beginners, tend to be a better option because a lot of the choosing is taken out of the equation. So the way that a fund works is, let's say I give £100 to a fund manager. And what this fund manager will do is sit on my money, your money, a couple of other people who have also invested into that fund. He'll take a big collection and he will invest it into this, into that, into there, and kind of a wide array of different investments. Different companies, the funds might invest into other funds, into property, like really isn't a limit. Now, it means the fund manager is doing the day-to-day running. You don't have to worry about kind of doing loads of research. You kind of have to make the initial fund choice. After that, you can sit back and relax because he's going to be the one every day kind of trading its value and tracking how well it's doing, making little amendments. So, but with funds, you can either choose to have them pay an income out to you. So kind of like, let's say, £5 a week gets paid out to you. You can then withdraw that, stick it somewhere else, use it to like get your hair done, something, you know, however you want to choose the money.
Again, just quickly, why would you get paid out? Why would you get money out?
So essentially, the fund manager would stick it into, let's say, X companies. If X companies are doing well and makes a profit, he will then give a share of that profit back to you based on how much you invested into the fund in the first place. And how many kind of units, which is like a part of the fund. Sort of like how shares are a slice of the pizza. It's very, very similar. If you have 100 units or 1,000 units, it shows kind of how much money you have invested into it and how much of the profit you can put your hand up and be like, oh, I think you missed it. That actually belongs to me.
And those are called dividends in general, or is that?
Yeah, in general, dividends, profit, there's lots of different terms that are bandied about, but it is ultimately, at the end of the day, profit, money that's being paid out to you.
Okay, great. So actually when people, I mean, you know, here comes the classic kind of stories. When someone talks about a trust fund baby or something like that, that's someone who has money in a trust and there's so much money in that trust that they can live off the profits which are being paid out of it. Is that?
Yes. Yeah, that's very similar. A trust fund baby is slightly different. Just because it's got the word fund in it doesn't necessarily mean that all that money was put into funds. But yeah, if you're a trust fund baby, it basically means that you had some very nice relatives or family friends who put a lot of money away aside from you when you were younger. That has now accumulated and you can kind of live off for the rest of your life if they made some clever investment choices.
Wow. God, this is the kind of
only.
Yeah.
Grandma, granddad.
Yeah, it begins to make you realize about this whole thing of accumulation and why this idea of the wealthy getting wealthier and wealthier can happen, because it, you know,
yeah, absolutely. That's why there's things like inheritance tax. So for example, if I, hopefully not for a while, am an absolute mega rich billionaire that dies, and my family want to kind of inherit some of the money, there will be a heavy tax on that to stop exactly that from happening, to stop it kind of staying just within a couple of wealthy elite, as it were.
Okay, great. So we're back. Okay, so there are the funds which are managed, and I'm guessing that's quite often managed by a hedge fund manager. Am I right? Yeah,
so a fund manager. Hedge funds are they're just a type of fund. It's got kind of like different implications. They're more popular normally in the US than they are in the UK. But no, it's a fund manager who's doing the day-to-day running. So for those people who kind of just want to sit back, relax, they're happy just to wait 10 years and see what happens, it's pretty ideal. Also, because it's the fund manager doing all the investing, he's not going to stick it all like just into one company like a new investor might. He's going to spread it as far as he can. So even if one company goes down, you've got like 50 billion others that are still afloat. So you're not going to get kind of like the extreme up and downs that you might see in other types of investments.
Okay. And where does index funds come into this in a way of?
My favorite. Index funds, they're kind of passively managed is probably the best way to say. So with a normal fund, a fund manager, they are actively trying to make as much money as possible. So they're constantly fiddling and kind of changing bits and bobs. Whereas with an index fund, it's looking to track something. So for example, there could be an index fund that tracks the movement of companies, the top 100 companies in the UK. So it's not actively going out and aggressively trying to make as much money as possible and kind of maybe making some risky investments. It's just trying to follow the general trends of the particular market that it's tracking. So again, the general rule is it might go up and down, but it will almost always go up at the end of the day. But because it's tracking something, for those of you who are kind of like faint of heart, who don't fancy logging into your account and seeing that today, you know, this company is down by 5 billion%, it's quite a good bet, because it's going to be more stable than other kinds of investments. So if you're looking for something that gives you kind of pretty good returns, like a little bit of interest, as it were, but is kind of conservative, is safe, you're not likely to kind of lose it all because you've taken a big chance on like a tiny startup or something, an index fund can be a really, really good bet because it's well diversified, it's just following something, it's not, or theoretically not, going to have all those crazy up, down, lows, sideways, diagonally, that's going to give you a heart attack when you log into your accounts.
Yeah, so I think, disclaimer here, I do have a stocks and shares ISA, which is invested in index funds at the moment. Nice. And well, slowly, not that there's much in there, but, you know, I got to set up, you know, that thing. And it's one thing which, correct me if I'm wrong about this, one thing I understand about it as well is that because index funds are passively managed, the percentage which people take for the management of it, because in general fund managers take a percentage of the growth out, actually there's a lot of debate in financial circles that actually index funds, no matter what, are actually financially more successful because hedge funds, because of the glory of what's it called, compound interest. Basic compound, again, correct me if I'm wrong, compound interest is when you the interest which you gain on it, if you reinvest it, it just continually cycles, so money which you never actually have touched is helping you grow. And the problem with a hedge fund manager is that they take out a certain amount, and if they take out a certain amount which is bigger every time, your compound interest is going to be lower. Is that right, roughly?
Yeah, pretty much. It will vary from kind of fund to fund and from fund manager to fund manager. But if there's someone there who's kind of sat every day managing a normal fund, a hedge fund, for example, and actively putting a lot of work, a lot of graph, a lot of research in, obviously they're going to charge more than someone who's just going, oh, this did this yesterday, I'm going to pop that there. So yeah, over the long term, not only are index tracker funds a lot more stable, but they are kind of cheaper, as it were. With a fund manager, you're trusting their expertise to be able to kind of hit on that one or two like companies, that one investment that's going to cause like a big jump up. So it's kind of whether you want to just trust the system, trust that over the long term, you're going to go up as all the other companies that it's being tracked go up, or if you kind of want someone actively doing all the work for you and putting the graft in, with someone obviously who's got a lot of expertise.
Yeah, okay. I think the other thing I think I know about index funds is that in general what you can do is you can just say, I want to invest in the FTSE 100 or in the S&P 500, which means the top 500 companies in the US or the top 100 in the UK. And frankly, if they crash and burn and the entire global economy is crashing and burning, you know.
No, that is exactly right. So an index tracker will track a hell of a lot of things, and like if the top 100 companies in the UK all go down, we've all gone down because a meteor has crashed into the sun, or there's been some other kind of tale of impending doom. You're not likely to kind of have the huge pitfalls. There are obviously exceptions, like 2008, it's going to dip, but it's unlikely to completely go bust, because if it did, you would hear about it in the headlines.
And I guess that if you were someone really watching it, in 2008 or in just at the beginning of the pandemic, that would have actually been the perfect time to buy in because everything would have plunged.
Yeah, exactly right. In investing, there's been a couple of days that have kind of become iconic. One of them was the vaccine day, when the vaccine was announced, because everyone suddenly wanted to invest simultaneously because it was kind of hope of a new future and hope that things are going to start get moving again. 2008, obviously, the financial crash is a example sort of for the other way, when things suddenly all went belly up. But yeah, with index tracker funds, they tend to be a lot more stable, simply because the economy generally tends to be somewhat stable-ish.
Yeah. Okay. Great. All right. Next question.
Yes.
So I am here. I am 23. Why should I be caring about this now rather than starting, say, 33, 34?
Simply because the more time under your belt, one, as I said, the general trend is it always goes up. 10 years can make a relatively big difference. So you want to start as early as possible to give your money as much chance as possible of simply gaining and gaining and gaining. It's also one of those things that when you're young, you can kind of do without, as it were, rather than when you've got a wife, kids, a mortgage to pay. So as someone kind of in their early 20s, if you do kind of have £1,000 that you can live without for the next 5 years, you could stick it into something. And even if, God forbid, everything goes wrong and you end up losing a fair bit of money, it's not going to be as disastrous as someone who was relying on that money to pay off their mortgage, to pay off their heating bills, to send their kids to school, etc., etc. You tend to have less responsibilities, as it were, when you're younger. So by sticking the money in now, it just means that you're not going to have to do it when you're 40 or when you're 50. Because also, once you've got wife, kids, etc., etc., you're not going to be willing to make the same sort of investment choices. You're going to stick to just conservative things that won't grow very much at all. And overall, you're going to kind of be kicking yourself that you didn't think of doing this earlier and have those extra 20 years of growth.
Yeah. I suppose it's also, if you get in the habit of even putting in, say, 10 quid every month, over 10 years, you've suddenly got a very sizable sum, which otherwise, would never exist. Again, because of compound interest, I suppose, as well.
Yeah, exactly right. So if you're sticking £10 into an ISA every month and it's growing, and 30 years later you're like, hang on a minute, I swear that I did something, etc., etc., that's going to be a really nice windfall to fall into. And when at a time when, you know, there are more things to pay for, that money does tend to kind of be needed a bit more and a bit more urgently as well.
Yeah, no, that's a really, really good point. Okay, so again, young 20-something creative who doesn't quite know what the fuck they're doing with their life, wants to go into the creative industries, doesn't quite know where. I've just had a great job, I just have this bonus, and I want to prepare for my future because I know it's going to be very uncertain, and I'm trying to be financially conscious, but also yeah exactly. Why are stocks and shares ISA versus a pension pot versus going for a mortgage?
So there's a couple of different investments out there. And again, kind of throwing back to your original question, once you've decided that investing is right for you, the next step is, okay, now where do I stick it? With the ISA, you have a £20,000 a year allowance. And you can put £20,000 a year in. I know, nicer problems to have, as if you're going to have any more. You can put up to £20,000 into any ISA product across one tax year. Now, there's no limits to when you can take that money out. So, for example, with a stocks and shares ISA, if I stick 20 grand in this year, there is nothing to stop me from a month later being like, actually, you know what, this isn't for me. I wouldn't be able to put any more into an ISA for that tax year, but there's a very easy out. You can just withdraw your money and kind of back out, as it were.
Yeah.
With a pension, for example, you cannot touch that till the age of 55. Does not matter what you do, you cannot access money in a pension unless, unfortunately, you have to retire early due to ill health or you're terminally ill. You're not getting your hands on that money until you're 55. So if you're like me, I'm cutting out briefly for a second. I'm back.
I'm back.
So if you're anything like me, I put money into my pension first, simply because I know if it's sat there in an ISA and I know that it's easily accessible, that's going to be spent on ASOS eventually. I don't have the self-discipline to actually kind of not touch money that I've earned when it comes to being like, oh, I could get a takeaway, bank account is looking low, ISA's doing quite well. Yeah. I know that I'm likely to dip in and out. If it's in a pension, I can't touch it no matter what I do. So it kind of takes the choice away, as it were.
Yeah.
Now, the fantastic thing about certain pensions is that you do get basic tax relief on them as well. So with an ISA, you're not going to be taxed on anything that happens while it's in the ISA, but on the way in, you don't have any help. That is your hard-earned cash. Whereas with pensions, you put your money in and the government is going to top you up by 20%. So you put £80 into your pension and you get £20 of tax relief into the pension as well. So the reason why that is fab, basically, the more money you can put into it, the more free money you can get. And again, it's building for your future. You cannot touch that until you're 55, going up to 57 in 2028. And for those people who kind of, like me, are very impulsive and likely to buy bright, shiny things rather than actually save, it can be a really, really good tool.
Okay, got it. So again, creative who's likely to be self-employed, so unlikely to have an employer who will have a pension system for you, won't and you know, and national insurance and contributions, all that kind of stuff. What pensions would you recommend if you wanted to go down that route for someone who is probably going to be self-employed for most of their life?
Sure. So one of the difficult things about being a creative is we don't have kind of an official workplace all of the time. There's been new movements brought in by the government surrounding pensions simply because a lot of people were getting to pension age and realizing they did not have enough savings. The state pension wasn't going to be enough to kind of carry them through. So as part of kind of trying to prevent that, there's now a thing called auto-enrollment, which means above the age of 23, your workplace will automatically enroll you into some sort of pension scheme and help you make contributions. If you're a creative and you're working on 0 hours contracts for 10 years, you likely are not going to make any pension contributions unless you have done it actively yourself. So one of the main types of pensions is something called a self-invested personal pension, a SIPP, as it's kind of called. And that is essentially where you can put your money in, any profits from a show, get that tax relief, and it will sit there until you're the age of 55, simply because it's not going to happen automatically for a lot of creatives. It's something people do need to be aware of, because you don't want to end up kind of at the age of 55 thinking of slowing down and realizing that actually the couple of savings you have are not going to be enough to last you through potentially another 40 years. People are living a lot longer than they normally do. The state pension is good, but you know, when you're 70, you don't want to just be living on like a cold baked beans diet off the state pension where, you know, you're getting a minimal amount that you can survive. You want to be splashing out on the grandkids, kind of traveling the world, doing all those things you put off doing for your pension. So it's important to have a good nest egg for survival, but also for enjoyment. You want to be able to buy a nice plush armchair to watch telly at, rather than having to kind of like make do and mend.
Yeah. So also with a pension again will be invested. So even as you're putting in a pot, it's like you have a choice in some ways. Once you choose no longer to have something just in a savings account, it will you can put it into a pension, a SIPP, likely for us, or into an ISA quite often, and both of them will be invested.
Yes, exactly right. Now, the great thing with a pension is, as I said, you can't touch it. So if you're making contributions now and you don't plan to retire until 67 roughly, that stuff's going to be invested for about 40 years. 40 years gives it a really, really long time to sit there and grow, which just means that you should hopefully kind of end up with a nice, decent figure a bit above kind of the inflation costs, and you've covered all of your bases.
Okay. Interesting. Got it. Okay, sort of getting there.
The difficulty is with self-invested pensions, you still do need to make the general investment choice. Stakeholder pensions, these are often offered by like insurance companies, and they do have a default investment option, as it were. So if you're someone who's like, I really want to invest, but I don't want to do any research, and kind of freaked out about making that decision, a stakeholder pension does have a default option. So if you're one of those people, you're like, I want to do it, but I don't have time right now to kind of be worrying about this stuff, a stakeholder pension is a good alternative. It has a more limited range of investments, but also a default option. So worst comes to worst, you can just be like, yeah, that one. And you don't have to worry about it. It is invested. It's not just sitting there doing absolutely nothing.
Okay, so if we just plan out the two routes of kind of the ISAs and the pensions now, so person number one wants to go to a pension and person number two wants to go into an ISA. Let's forget about person two for a second. Person one has this money. Can you give just a step-by-step of perhaps what companies they might go and Google, or what steps they need to Google to go bum, 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 and you're in? What do they do?
Sure. So with pensions, if you're looking specifically to invest, you want to be looking for investment banks. So places like Lloyd's, Halifax, Hargreaves Lansdown are kind of like big investment banks. If you're kind of hoping just to kind of have that default option, if you don't want to make any decisions at all, you don't want the freedoms that you don't want lots of choice, you probably want to be going to insurance companies such as like Aviva, for example, for a different type of pension. So it's kind of sitting down and thinking, all right, how ready am I to actually commit to this? Once you've decided that, let's say you think, you know what, I've done some swatting, I've got some funds that I'm going to stick it into, I want to go for an investment bank. You would then essentially just want to Google self-invested personal pension. Now, the thing about investment banks is they will all have different charges, different rates. I know, as awful as it sounds, it is worth checking each company's terms and conditions. Maybe not all the fine print, because they tend to be like 80 pages long, but you want to have a look at the charges and the tariffs, because there's no point putting loads of money into a pension if the management charge for that particular company is going to be like 500 quid. So you want to kind of do your research as to where you're going to stick it. Now, obviously, these companies want you to invest with them. So there'll be lots of information. There also will be like third-party reviews. You can have like a YouTube. There are kind of reviews of, for example, investment bank X's SIPP versus investment bank Y's SIPP. You can kind of have a look, even give them a ring. I know that it's a little bit old-fashioned, but actually people on the end of the phone are going to be able to give you a good idea of sort of what the company's like. If the customer service experience is awful, don't go there. If you have a really great customer service experience and they're happy to chat you through and give you some information, you know, it's likely going to be a company that's reputable and going to be helpful, particularly for a first-time investor.
Great.
So let's say you want to go into investment bank A to get a self-invested personal pension. You want to apply. Most places you can do this online. You can do it over the phone. You can do it through the post. You're going to have like your national insurance number to hand, and they'll have to do like a couple of background checks on you just for anti-money laundering purposes. And once that is done, your SIPP will be open and you'll be able to start making contributions. With most places, you can do kind of a lump sum, stick £40 in, and then you'll get that 20% top up 6 to 11 weeks later. Also just directly apply to the account. A lot of places as well, you can do a regular savings. If it's really something you don't want to think about, you can say, okay, £25 a month, I want it to go into this particular index tracker, and that company will just take £25 a month from your bank account until you tell them to stop or you ask them to suspend it. That way you don't really have to think about it. It will all be done automatically. You can pop in and check every now and then. But for someone who's going to have kind of a varying level of income potentially as a creative, having even a nominal amount over 30 years is going to build up quite, significantly.
Yeah, no, that totally makes sense. So just a quick question on this, management fees, ballpark figure, what's reasonable and what is like excessive? Because again, someone from completely outside.
Sure, no, that's absolutely understandable. So it will differ from company to company, and it can also differ depending on what you're holding. So, for example, if you're just holding cash, most places don't offer an interest rate on money that's just sitting there because it's an investment bank rather than just like the bank.
Yeah.
So there's not normally a charge associated with that. Personally, where I work, the fee is capped for holding equities at £200 a year, but that is the maximum that someone would ever pay. It's normally a lot lower than that. I currently am paying, I think, like 15 pence worth of fees, 15 pence worth of fees, 15 pence worth of fees every month for what I currently hold, and that's a couple of different accounts.
Okay.
So that's kind of the rough idea. If you're looking for financial advice, if you kind of want to sit down with an advisor who will be like, stick it X, Y, and Z, that is going to be hefty because, you know, they're the experts. And again, it will differ from place to place. So it's a really good idea to shop around, to look at people's experiences, sort of like if you've got two very, very similar products on Amazon, and the price difference between the two of them is absolutely nominal. It's kind of like really, really close neck and neck. First thing I always do is read the customer reviews. If one of them is kind of like all 1 star saying it's trash, or I've broken, it was the size too small, I then it's the other one. And if it's got 5 stars, obviously you're going to go there. So while investing kind of is a great thing to get started, it's not necessarily something to rush into. Some investment banks will have like extortionately high exit fees, or they might charge you for withdrawing, which is why I said, even though it's super boring, reading the terms and conditions or ringing up and asking for a breakdown of their charges to be emailed to you is super important, so you don't end up with kind of any hidden nasty figures.
Yeah. Okay, great. So person number 2 who's decided actually pension, you know, I'm a miser. I'm a miser. You know, I once it's in, I probably won't touch it again, either miser or laser. So I'll go for the ISA because, you know, for whatever reasons, possibly an index fund. What are the steps on that route if you decide to go that way?
So that's going to, again, be pretty similar. It's going to be a case of what investment bank is going to kind of give me the best experience, which is the most helpful, etc., etc. Once you've found your where, you then need to kind of choose between ISA products, because there's not just one, not just the stocks and shares ISA.
No.
There's a couple of different things.
Okay.
So with the kind of reason for investing, if it's you want to stick some money away and you're going to use it for your first house purchase, if you're really, really keen to kind of get on the property ladder, you could open something like a lifetime ISA, which is where there's a maximum of £4,000 here you can put in, and maximum the government's going to top you up by 20%, so 25% in fact. So if you put £4,000 into your lifetime ISA, the government is going to give you £1,000. But again, you can only take that money out literally when you're buying a house, or else you'll get 25% reduced, and that's of the overall amount, not necessarily what you put in. So if that's why you're investing, a lifetime ISA could be a good shout, because one, you can't access it, so no need for self-discipline. Also, literally free money from the government. Lifetime ISAs are the number one thing that I kind of rave about to all my friends, because it's like you could literally get £1,000 each tax year. If on the 5th of April you stick £4,000 in, and then on the 6th of April, when the tax year changes over, you stick another £4,000 in, you're going to be £10,000 kind of when all is said and done and the dust is settled. Stocks and shares ISA is just your bog standard ISA. A cash ISA, also something that is offered. That is the same, except it's not invested money necessarily. It's just cash, and it will look to offer you a good investment rate. So we're talking like 2% rather than 0.01. Thank you, Halifax. So you then kind of want to think of your reason for investing. Once you've got that and you're like, yep, I want this kind of ISA, the next step is, again, just to find a provider and open an account. Most account openings can be done online. Sometimes if you've recently moved, there can be a bit of problem because banks have to kind of find you at your particular address. But normally you just need to send in something like a council tax to prove that you really live there, and they can then kind of get it open, get it cracking. And a lot of investment banks will have information on the investments they have and how to choose investments on their websites. They're for free. So it's worth scrolling through their YouTubes. It's worth having a look on the different websites and seeing the kind of information that they offer.
Great. Okay. Yes. So banks for ISAs are stuff like Hargreaves Lansdown, Vanguard, who are the ones I'm with, and those kind of ones. I might just quickly explain why I chose to go stocks and shares ISA, just for kind of the decision makings of, just to show a different kind of thing as well, which was that I was very tempted by lifetime ISA, but I found an article by Money Saving Expert, and I'll link it below if I can find it again, which explained that one problem with lifetime ISAs is that either it's a house purchase or it's a pension. And it's really interesting hearing you talk about pensions, because what they said is, especially if you're self-employed, you shouldn't be putting into a lifetime ISA for a pension, because it's about when the money is taxed. And one is taxed at the point and one is taxed afterwards. And the other point about lifetime ISAs in the UK is that the total house price, which you can buy with the money from a lifetime ISA, is capped at £400,000, which is, if you want to buy anywhere in London, which a lot of us as theatre creatives are very tempted to, if we're going to buy anywhere, that is not, you can barely get a bolt hole in London for 400,000, especially as inflation goes up and just like the house prices go. So I went, okay, stocks and shares ISA, and that seemed like the better option for the money to grow, and then I could choose later on where it might go. But I hadn't heard of SIPPs. I had heard of them, I hadn't understood them before, so that's really interesting as well. And they aren't mutually exclusive either, are they? So it's
nope, you can hold both.
Yeah.
With ISAs, there is kind of, you have your £20,000 over all ISA products you have to stick to, or else HMRC will be very, very angry. But if you want to put 4 in your lifetime ISA, 1 in your cash ISA, you can't then stick 20 in your stocks and shares. It's 20 overall for each tax year. Yeah. And again, it's really, really interesting to hear you say like about the flexibility. I just have no faith in myself. I know that like if that money was instantly accessible, there's just a much higher chance that I'll dip into it. Whereas, actually needing something above the lifetime ISA allowance, or kind of needing the money or wanting to use the money before that potentially, people are going to split it one or two ways.
Yeah, it's really interesting that as well. So wait, just another kind of final clarifying thing on this is the £20,000 kind of total which you could put in. So you could have 3 ISAs theoretically, you just couldn't go beyond the total of 20,000 a year. Is that right?
You can have one of each type.
Yeah.
So you could have 1 cash ISA, 1 stocks and shares ISA, 1 lifetime ISA. You can't have 2 stocks and shares ISAs open in the same tax year. So you can only pay into one of them. And largely, I imagine that's to basically make sure that there's not people having one over here, and not telling HMRC about the other one. You can only pay into one. You have to go through a huge old list of declarations every time you contribute, and each tax year that you contribute, because it's one of each. So you can have 3 different ones, but not 3 stocks and shares ISAs in the same tax year.
Got it. Okay, and so it's and SIPPs don't contribute to that limit, right? Or
no.
Are they?
SIPPs have got their own limit. It's £40,000 a year as the massive annual allowance, and like I wish, but I don't think I'll ever make that much in a year unless I get very lucky and win the lottery. But it's limited by the greater of 3,600 gross, or 100% of your relevant UK earnings. So you could put, if you earn 20k a year and you stick some aside for savings, and a couple of years later you've got 20k you can put in one great big lump, that's the maximum you'd be allowed to contribute. Now the big thing with SIPPs that causes confusion is that you make your payments net. So if you want £1,000 to go into your pension, you only actually pay 800, because the other 200 is the tax relief from HMRC that will be put into the SIPP a couple of weeks later. So there's a lot of cases where someone puts in £1,000 because they wanted to put in £1,000, and they end up actually putting in £1,250 because they get the tax relief and then they're over the limit, etc., etc. So again, as boring as it is in the world of finance, actually reading the declarations and all the boxes that you're ticking is actually quite important.
Oh God. Yeah. And this is the point where all of us kind of go, too much information. I want to create art. What am I doing?
Exactly. It's so boring, but it's one of those, it's a necessary evil, basically.
Yeah. All right. So in your kind of general opinion, I won't say financial advice, but general opinion.
Please don't.
I
did an English degree.
Yeah. Yeah, exactly. Yeah, for viewers to know, financial advisors is a very specialized thing, which of course neither Megan and I are. That's why you put a declaration at the very beginning. So this is information as we understand it for creatives. We can't say that this is financial advice. How much should we be thinking about percentage? Again, we all think we should save, and okay, these are all the options of how to save. But if we're going right back to it, how much should we be aiming to save? If we're going...
That is a really, really good question, and not to cop out, but one that does depend on your individual circumstances. So if as a creative at the moment you're having kind of a dry spell and you're literally living paycheck to paycheck, obviously this isn't something to be worrying about.
No.
If you're finding yourself kind of comfortably sitting on £200 a month that you could, it's just sat there in your bank, not really doing anything because the interest rates are so low at the moment, you might then want to think about putting £50 aside each month. You want to have enough that if something awful happened and you had to pay out £5,000 suddenly, you would be able to do that. Yeah. So we're talking, for most people at least, a very small amount. Perhaps if you get given, 100 quid from your nan at Christmas that you don't actually need, you could stick that in there on kind of like an ad hoc basis. But for most people, it's going to be a little, and it builds up to a lot because investing is for the long term. So if it's £10 kind of a month, and then, as you get another job, you can afford to increase it to £12 and kind of keep on top of things. It will surprisingly build up without you actually having to think about it that much at all. With pensions, the general rule of thumb is that you want to be putting in, as a percentage, half of what your age is when you start investing. So if you're 22, the industry experts say that ideally we want to be looking at putting 11% of your salary. For most people, in this economy, with all the internship, etc., and the low starting prices, that's not always necessarily going to be realistic. It's going to be up to you to kind of decide how much you can manage. Obviously, the hope is that you'll become a super successful actor, actress, songwriter, harpist, whatever it is that tickles your pickle, and you'll be able to stick a lot more in. But it's about kind of being sensible, taking control of your own budget and thinking, okay, you know what? I don't need Wagamama's for the 6th time this month. That is £20 that I could have stuck in my pension. And kind of just thinking for the long term to get you through those periods where you don't necessarily have work, etc.
Yeah, I think one reason I hope we do a bit of a series with a lot of people on Bardic about money, and perhaps coming back to you, Megan, because obviously you are absolute financial, or closest financial expert we have of current contacts. But I think one reason we do need to think about it and think about it hard, especially just as we're starting out, is that in my mind, one of the main reasons why people leave the industry is because of security. It's this thing of you have to constantly be there waiting for someone else to give you that job or to give you that opportunity, and you're there at a dead-end job because you can't commit to another job should possibly pay more. And in my mind, it's if we began to understand money at a very early stage in this, and actually then in 10 years, right at that point when you're hitting that breaking point, you can look back and go, actually I have just enough, which means that I could be paid 50 quid a month from my investments I made earlier, which means that I just have that little buffer, which means I can make rent and I can keep on with the dream that much longer. I think that's why I think it's important. But what do you think about that?
I agree wholeheartedly. It's one of those things that unfortunately this industry is a cruel mistress. What happens to a lot of people is they put a bunch of gung-ho into it when they're young, and then kind of as they're reaching 30ish, having to kind of think about the long term, think about rent, think about maybe wanting to start a family, etc., you're less able to take risks. Someone who is kind of in their middle ages is less likely to be able to drop everything and go for that dream audition or go work on a cruise ship for 6 months because of other ties. If you have sort of used your youth and your kind of like lack of responsibilities wisely, you're just kind of giving your older self kind of a little bit of wiggle room, which I think for a lot of people, There's lots of famous actors and actresses who didn't get their big break until quite late on in their lives, but if they were having to work a 9 to 5 and they had absolutely zero margin for error, as it were, they may not have been able to do that, and we wouldn't have such incredible talent as we have found.
Exactly. Yeah, it's just the exhaustion level if you have to keep on living paycheck to paycheck constantly with no feeling. Oh, all right. So I think we're coming to the end, but I think that one good thing to think about now is that if someone is listening to this and has and is totally understanding it all, well done you, firstly. But and it's also going, I also legitimately worry because I really am like, there's nothing in the bank. I am living absolutely to my extremes. How do I get to a position as this theoretical person where I can begin to make these choices? What savings should I have for emergencies? And when should I begin to be able to start putting it that way? How should I aim for that? What would you say?
Yeah, I think basically banks at the moment, your money's almost doing worse than nothing because the interest rate is lower than inflation. So if you really, really have nothing more to give, as it were, the very least that can be done is to stick your money into something called an active savings product. So, for example, if you're with, I don't know, Halifax or some other bank and you're currently getting 0.01% and you've got 10 grand in there and that's the only money you have in the world, you're not currently employed, you're really worried about it running out, you want to get it somewhere that's at least got a bit of a better interest rate. That's the starting point, because as like we've hopefully established, over the long term, tiny little things can make a big difference. So again, a lot of banks offer active savings, which is where you can find competitive rates. You can see that, oh, actually NatWest is doing better, or HSBC is on 0.4. You're talking tiny margins, but tiny margins over years can make a big difference. So that's kind of the starting place. Trying to find a bank that is giving a competitive-ish interest rate is probably going to be where you start if at the moment you really are paycheck to paycheck, simply because it'll be giving you a little bit, and when you're paycheck to paycheck, you know, a little bit can be the difference really between having water and not having water, etc. After that, it's then kind of how much you're living in excess, and then a portion of that being put away for the future.
I think I heard once that one good way to think about it is make sure you have 3 months easily accessible of living expenses, and after that actually you can survive. Think about it that way rather than do you?
Exactly right. And it's one of those things as well, as kind of misery, to use your word, as it sounds, it's also kind of going things like, well, you spent £80 on new clothes from Primark last month to make yourself feel better, and kind of finding areas in your life where you can kind of slim down. If you're someone who's splashing the cash at Waitrose, heading over to Lidl, it's really surprising kind of where you can start to make adjustments. Subscriptions for things, do you honestly use Disney Plus that often? Isn't that a £5 each month that could be stuck kind of towards the future? So while living stringently now, when you're young, and again, you're not having to pay for the kids' school shoes, etc., can actually help you kind of get the start of your foundation so you can retire in luxury, hopefully very famous and having been a very successful creator.
Great. Fab, Megan. Thank you so much for this. I think we're coming to the end, but I have one more question, which I'm trying to ask everyone if I can remember when we do.
Okay.
Which is, what's the one piece of advice which you've learned recently, which you would give back to kind of 18-year-old, 16-year-old you? What's the bit which you would pass back if you could?
Oh, that's a very good question. Like general life or specifically creatively?
I think in this form of thinking coherently about being a creative, I think probably.
I think I probably would have told myself, don't give up so easily, or don't mentally resign yourself. I think when I was 18, I was very much of the mind of, if I don't go to drama school right now, I'm never ever gonna make it. I'm never gonna be happy. And I think the one thing I would say to younger me is, one, don't bother auditioning for drama school because you won't be able to afford it. But also, like, what does make it mean? I feel like when you're young and impressionable, you are often told you want to get your big break, you want to do this, you want to do that. Whereas actually, I'm very, very content with a couple of like professional gigs that I've done. I haven't got my face plastered all over the place, but I've been able to kind of like nurture that creative soul. And I think that's what I would have told myself. That's what's important. Making sure the shows you're in are the ones that you like, the ones that you think say something or do something, or that you just really bloody enjoy because they're super funny, rather than doing a show for the sake of it because you want to get more experience. I think I would have said you can afford to be a bit more choosy because there's opportunities abound. You don't have to do every single thing that comes your way just for the sake of it.
That's a really, really good point. Yeah, it's a nice one about contentment, about what actually will make you feel good and successful, and actually how that will then translate later because you can keep it going longer, I suppose, as well. You know.
Yeah, I mean, I think I'm one of those people that I haven't at least yet gone for it like 100% full time, simply because I don't have the money. But it's one of those things. I think actually just don't audition for every single show that comes up at uni. Go for the ones that you actually like, that you want to be involved with. Kind of do what makes you happy, not just being in rehearsals because you've always done rehearsals and you usually enjoy rehearsals. You can kind of take time to get to know what you like and why you're doing this, rather than just kind of impulsively signing up for everything.
Yeah, I think that's really, really good advice. Great. All right, thanks very much, Megan.
That is absolutely no problem. Please don't take any of this as financial advice. But no, like seriously, it's one of those things. The information is out there. It's just kind of taking an hour or two to sit down and pick through it all. I was very lucky to taught all of it as part of working, so I didn't have to kind of go through the laborious stuff. But any questions, etc., if you kind of comment below, I'm sure someone from Troubadour will happily get back to you.
Yeah, definitely. I'll also, in the description, I've found, when I was doing my research, I found a few videos, so I'll drop them down there as well if anyone would like anything further. Fab. All right. See you very soon for All's Well. Am I going to put that in? I don't know.